As of 2024, digital payments have surpassed traditional cash transactions in the United States. According to a Federal Reserve report, cash accounted for 16% of all payments, making it the third most used behind credit and debit cards. 16% of all transactions in coins and cash. That's crazy because when I was growing up, it was probably more of a 50-50. And I know a decade before that, it was probably 60-40 or even further on the cash side. In contrast, digital payment methods, including credit cards, debit cards, and mobile wallets, have seen significant growth. A McKinsey report notes that 74% of consumers consider ease of checkout and security as primary reasons to use digital wallets. Additionally, a Capital One shopping study found that 47.8% of American adults make no cash purchases in a typical week, indicating a strong preference for digital payments. So what if we inverted those metrics and had a economy where 75% of us used hard assets, be it silver, gold-backed currency, which I know a lot of states are moving towards. This is a gold-backed. So what if we went back to either a gold or silver-backed currency like we used to have, or even just went to a majority cash society where 70% plus of the economy was based on transactions of hard assets? And how do banks monetize us using digital currency? I think you'll be shocked when we get to that part. You know what? Let's start with that part. Because we are in a digital age, why does that benefit companies like banks who issue you these credit cards? And as you know, there are credit cards for all types of things nowadays. And so that's what we want to look into. How do these institutions monetize me using their debit or credit card? The first one is pretty easy: transaction fees, which we consider to be merchant fees. Every single time you use your credit or debit card to make a purchase, the merchant pays a fee to the bank that issued the card, known as the issuer, and the payment network like Visa, MasterCard, or American Express. This fee typically a percentage of the transaction amount, which can range from 1 to 3%. So how does that benefit the bank? The issuing bank gets its share of the fee, and it is a consistent stream of income as long as people use their card for their purchase. These fees can add up significantly, especially in high-volume, low-margin sectors like retail, which is why you can have Bank of America, for example's name on a stadium where they paid hundreds of millions of dollars for those rights. Why do banks have the ability to make that much money off of you? And really hurting the merchants, because the merchants now have 1 to 3% margins taken away from those assets, which usually means they have to hike up the price 1 to 3% to incur those fees. The second area is interest charges. That's really for credit cards mostly. Credit cards typically come with interest charges if you don't pay off your balance in full each month. They call that the APR. That can be quite a big number, often between 15 and 30% depending on the card. So obviously that benefits the banks. Banks make a large portion of their profit from the interest paid by cardholders who carry a balance month to month. The longer you carry a balance, the more you'll pay in interest fees. This is a major revenue source for banks offering you credit cards. And in fact, I would say it's a form of slavery to a degree, because you are now basically owned by the debtor or the lender. The third area is annual fees. Some credit cards, not all, but some charge annual fees to the cardholders. Premium cards, like those offering rewards, travel perks, or cashback, tend to have higher fees, ranging from $50 to several $100s per year. Those fees provide direct revenue streams to the bank, especially for cards offering those special benefits. Even if the cardholder doesn't use them often, the bank still collects the fee. Area 4 are our late payments. When a credit card holder misses a payment or makes a payment after the due date, the bank charges a late payment fee, which can be substantial, usually ranging from $25 to $40 per missed payment. Late fees contribute to the bank's profitability, especially if a significant number of customers incur them regularly. The fifth area is going to be cash advance fees and interest. If you use a credit card to withdraw cash from an ATM, the bank typically charges a cash advance fee, often between 3 and 5% of the withdrawn amount. In addition, interest on cash advances is usually higher on other regular purchases and start accruing immediately. These fees and interest rates generate additional income for banks, as they tend to be quite high and are often a result of emergency situations for cardholders who need immediate cash. Point 6 is our foreign transaction fees. When you use a credit or debit card for purchases in foreign currencies while traveling abroad, banks often charge a foreign transaction fee, usually around 1 to 3% of the purchase amount. These fees can add up, especially for frequent travelers, and represent another source of revenue for the banks on card usage outside the domestic market. Point 7 are the interchange fees. The interchange fee is a fee paid by the merchant's bank, the acquiring bank, to the cardholder's bank, which is the issuing bank, every time a transaction is processed. This is one of the largest sources of revenue for card issuing banks. It's a small percentage of each transaction, but it accumulates significantly over time with high transaction volumes. It's shared between the bank and the card network, and sometimes other parties involved, like processing the payment, are rewarded. Cardholder fees. Point 8. For some debit cards, some banks charge for things like overdrafts, ATM withdrawals outside their network, or even to simply maintain the account. These fees create steady revenue streams for banks, and they often incentivize customers to keep their accounts in good standing, which may also encourage card usage. Point 9. Many credit cards offer cashback, travel rewards, or other incentives. While card holders see this as a benefit, those problems often involve partnerships with retailers, airlines, and other companies. The banks make money from affiliate partnerships and merchant agreements by offering discounts or points that can be redeemed for rewards. They may also benefit from the data they collect about cardholder spending habits, which can be used for target marketing and further monetization, which brings us to point 10, data and marketing. This is a big one. Banks collect a wealth of data on your spending habits, include what you buy, where you shop, and when you make purchases. They may use this data to develop a targeted marketing campaign or share it with third parties for a profit. In some cases, banks may sell anonymized consumer data to companies for marketing or research purposes. Very, very interesting. So as you see, banks have a vested interest in you no longer going with cash and moving towards the credit cards, which is why every single time you go shop somewhere, be it Old Navy, Bass Pro Shop, or even Walmart, they want you to have their card because they know if you get on their card, they're liable to make money off of you. So now we've talked about what banks do and how they can make money off you being digital. Let's think about the inverse, using 75% of purchases not on digital currency like debit or credit cards, but rather on some type of cash system, be it on gold-backed systems, silver-backed systems, or our fiat system that we're currently on. What would that do? So these are some benefits. Point 1 is improved budgeting and spending control. With cash, individuals physically see their money leaving their wallets, which can make them more mindful of spending. This can encourage people to stick to a budget and avoid overspending. And there's actually research behind that. The pain receptors in the brain, when you hand over $100 and get, $87 back, it actually does something to the brain. The second area is limited spending. When you pay with cash, you're restricted to the amount you have on hand. This can prevent impulse buys and lead to more conscious financial decisions. If people use cash instead of credit cards, they're less likely to rack up debt because they can only spend what they afford. This could reduce the risk of carrying high interest balances on credit cards. What about control over financial privacy? Cash transactions are private. No digital trail here. Unlike card payments that are recorded and could be used for profiling or tracking. Some individuals value this privacy and the ability to control who has access to their purchasing data. Cash transactions don't come with various fees that come with a card use, such as interest on credit card balances, late payments, or foreign transaction fees. Using cash eliminates the risk of online fraud, hacking, or identity theft that can occur with digital payments, making it in many ways a safer option in terms of privacy and security. With cash, there's no concern about unauthorized charges on a credit card or the need to lock a compromised account. Well, what about businesses around you? Well, when customers pay with cash, businesses don't have to pay the processing fees associated with credit and debit cards, which are typically 1 to 3% of the amount. These fees can be significant for small businesses with slim margins. Without the need to pay fees to payment processors, businesses can retain more of the money they earn from sales, improving their overall profitability. What about transaction speed? Well, cash transactions are instant and don't require the time it takes to process card transactions, which sometimes can involve authorization, verification, and waiting for approval. This could technically improve some checkout times, especially for small businesses with high foot traffic. For some small businesses, especially with those with low-tech or rural areas, cash payments can be a simpler and more straightforward way than relying on complicated digital payment systems or dealing with card machine issues, like when the internet goes down. What about financial flexibility for small businesses? Accepting cash helps businesses maintain liquidity, which can be especially important for smaller operations that may not have access to credit lines or loans. It ensures that they have money on hand immediately to cover operating expenses, pay suppliers, or reinvest in the business. Businesses that rely on digital payment systems are subject to availability of those services, such as internet access, working payment terminals, or issues with payment processors. Cash transactions really eliminate most of those dependencies. We have a reduced risk of chargebacks as well. Credit and debit card transactions can be disputed by customers, and if the bank rules in favor of the customer, the merchant is forced to return the funds, called a chargeback. With cash payments, this risk is eliminated because the transaction is final once the money changes hand. Point 5, appeal to certain customer segments. Some people, especially in rural areas among certain demographics, may not have access to credit cards or digital payment systems. Offering cash payments allow businesses to cater to these customers, expanding in their customer base. These are going to be in real rural areas, such as maybe Quakertown, Pennsylvania. Certain customers may also prefer using cash due to the unfamiliar aspect or lack of trusting in digital payments. Businesses that accept cash can ensure they don't alienate those groups. And for community benefits, well, cash stays in the community for the most part. When individuals use cash in a local business, the money tends to stay within the community. Local businesses are more likely to reinvest those profits in local suppliers, employees, and community projects, which helps the local economy grow. By reducing their reliance on large payment processors like Visa or PayPal, small businesses can retain more money within their operations, helping them survive and grow, especially in competitive markets. Low-income consumers, or those who don't use credit cards regularly, can avoid fees associated with digital payments, such as overdraft fees or interest on credit card balances. Paying with cash might be the most financially manageable way for them. Using cash can also help individuals better understand the flow of money, making them more aware of their financial limits and helping them avoid the temptation to spend beyond their means, fostering financial literacy. There are some drawbacks that need to be considered, such as inconvenience for large purchases. If you carry a large stack of cash with you, it may be impractical for expensive items or, obviously, online purchases. That is hugely inconvenient in our Amazon-driven world. It's also a little bit of a safety risk. Not that I'm expecting the majority of us to go get robbed when we're at Walmart, but if cash is lost or stolen, it is much harder to track or recover than digital transactions, which have somewhat of a footprint. And obviously, we have some limited acceptances. Not all businesses, especially larger ones or operating online stores, may accept cash. So that being said, in conclusion, using cash for a significant portion of transactions could definitely help the individuals exercise more control over their spending and avoiding hitting fees, while benefiting local businesses by reducing processing fees and speeding up transactions. However, a balanced approach is probably necessary for you to navigate what's right. So in conclusion, the shift from cash to digital payments in the United States continues to accelerate, with digital methods overtaking cash as the dominant payment choice. Reports from the Federal Reserve, McKinsey studies, and Capital One's shopping study highlight how cash transactions make up smaller portions overall, while digital payments like credit and debit and mobile wallets are on the rise due to their convenience, security, and efficiency. However, envisioning a scenario where cash is used for 75% of transactions could significantly impact the economy, business, and consumer behavior. In fact, a major shift back over a short period of time would likely reduce the efficiency of financial systems. It would slow innovation in digital finance and pose challenges for businesses, especially those with high operational costs tied to cash management. Consumers who transition into majority cash purchases might benefit from better control over spending and debt, but they would also face the inconvenience of carrying cash and raise the risk of, let's say, theft or loss, though these risks might be minimal based on where you live. Local businesses in a majority of cash-used markets could see a reduced transaction fee, faster payments, and increased profitability. At a community level, cash transactions could foster local economic growth and financial literacy. Ultimately, while cash offers some amazing tangible assets such as privacy and control and overspending, the benefits of digital payments such as speed, security, and financial innovation are also, hard to overlook. A balanced approach, leveraging both cash and digital methods, appear to be the most practical way that I see to move forward for individuals, businesses, and society as a whole. But I want to know what you think. Do you think a transition back to cash being a major token of transactions is warranted? What should the blend be? 50-50, 60-40? Should our assets be used to prop up banks? I would love to know what you think, and I would love to know if this video in any way has opened a door or reinforced an idea that you had about cash versus digital currency. Thank you so much for watching, and as always, please remember to stay classy and current with the culture of currency.